By now we are all very well aware of the fact that high inflation is more persistent than anticipated. And high inflation over a prolonged period of time creates problems, both for consumers but also for businesses, and thus for stocks. So today you will learn how you as an investor can best navigate a world of rising inflation. And if we just take a look at some data here, the consumer price index has actually reached a new high in January 2022 with an annual inflation rate of 7.5%, the highest inflation rate since 1982. And the PPI, which is an index that is more focused on the input costs producers have to deal with, is also incredibly high, impacting businesses' ability to generate profit. So as I said, in the current high inflationary environment, it is incredibly important for investors to understand how exactly companies' ability to generate profit is affected by high inflation. And once you have this understanding, you can figure out which companies are better suited to generate satisfying returns for investors in a high inflationary environment. And so today I will outline which two characteristics investors should look out for if they want to protect the purchasing power of their money. And so without further ado, let's get started. Alright, hello fellow intelligent investors, my name is René Zellman and I would actually like to start today's video with a clip of Warren Buffett in which he explained why inflation is a problem for many businesses.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices, people are raising prices to us, and it's being accepted. I mean, it's not, if we get, well, take home building. I mean, the cost of, we've got 9 home builders, and in addition to our manufactured housing thing, and then operation, which is the largest in the country. So we really do a lot of housing. The costs are just up. Steel costs, just every day, they're going up, and there hasn't yet been, because the wage stuff follows. I mean, if the UAW writes a 3-year contract, we got a 3-year contract. But if you're buying steel at General Motors or someplace, you're paying more every day. It's an economy really, it's red hot.
So in that clip, Buffett talks about the rising input costs businesses are facing. So he talks about home builders, for instance. And if you look at the construction input prices, for example, well, they were up 23.1% year over year in December, as we saw significant increases in common construction material prices like aluminium, lumber, or copper. And in addition, Buffett talked about the fact that inflation in the cost of commodities often comes first, and wage inflation usually follows a little later. We can also point out that when producers face input cost inflation, the increases in their production costs are usually only slowly, if ever, passed on to retailers and consumers. That is why the PPI index, which is focused on the costs of the industries that make the products, is often seen as a pre-indicator of inflationary pressures at the consumer level. And so, of course, a business's profitability will, at least in the short term, be affected by input cost inflation. Let me illustrate this with an example. Let's consider a fictional home building company and take a look at the income statement of said business. As you can see, it generates revenue of $1,000 after paying for its cost of goods sold. So that's basically the input costs. The company posts a gross profit of $350, so that's a gross profit margin of 35%. It's indirect operating expenses, so administrative costs, marketing expenses, research and development, or salaries paid to employees who are not directly involved in the manufacturing process, make up $150. So after deducting all of these expenses, the business ends up with $200 in operating profit. Now the question is, what happens to that business if it experiences input cost inflation of 5%, for example? Well, input cost inflation is obviously first and foremost going to impact the cost of goods sold of our home building business. So let's assume input costs increase by 5% in year 2. And as you can see, the direct costs of producing the goods sold by our home building company, so cost of goods sold, are up to $683. And as a result, gross profits and operating profits went down. If input costs now continue to go up in the next year, another 5%, the company's profitability will further be impacted. And within just 2 years, the homebuilder's gross profitability is down from 35% to 28%. And its operating profit margin is down from 20% to 13%. So as you can see, high input price inflation absolutely creates a challenging environment for businesses to do business in. Now, obviously, this example is a little simplified. Inflation does not only occur in the cost of input materials. Eventually, these costs are, at least to some extent, passed on to consumers. So while the initial impact of input cost inflation is not on consumer prices, but on company profits, it will eventually also affect consumers. Or put differently, while input inflation is primarily increasing cost of goods sold on the income statement, consumer price inflation will primarily influence a firm's revenue as well as its indirect operating expenses. And we will discuss why this is important in just a second, so please stay tuned. So to wrap up this first part of the video, I want to highlight a Twitter thread by the Twitter user Heikki Keskiväli. He studied the American WD-40 company, which basically manufactures maintenance and cleaning products under its signature brand WD-40. He showed that in the case of WD-40, the company's year-over-year changes in its costs of goods sold have actually pretty much tracked the development of the PPI index over a couple of years actually. Again, the PPI is basically the business version of the consumer price index. And obviously, such a close relationship between these two metrics is not typical. It very much depends on the business model of each company you look at. But it shows that especially manufacturing companies, well, their business fundamentals are absolutely impacted by producer price inflation or high producer price inflation. And so investors should be very well aware of that factor. So the question you are all here for is certainly how you as an investor can best deal with this underlying problem. Is there a way to avoid or at least reduce the impact of producer price inflation? Well, I think there absolutely is, and I will actually show you 2 strategies that help you find companies that can in a way fend off high inflation. So the first tip is to pay attention to the margin structure of the businesses you invest in, because the margin structure will absolutely influence how companies are affected by inflation. And as I've just said, or companies in the manufacturing space, they are prone to be adversely impacted by input cost inflation. These companies usually have comparatively low gross profit margins because due to their business model, they have high production costs, high costs related to the production of their product, packing and raw material costs, as well as direct labor costs related to the production of the good. On the flip side, companies with low production costs and high gross profit margins are simply better protected against inflation. And this is actually what Terry Smith, CEO of Fundsmith, wrote earlier this year in his 2021 letter to investors. The higher a company's gross margin, the difference between its sales revenues and cost of goods sold, the better its profitability is protected from inflation. And I want to illustrate this statement by comparing our home building company to a more capital-light business like Adobe, for example. So let's first of all take a look at our home building business. If input cost inflation is 5%, the company's operating profits declined by 32.5% from $100 to $68 after just 1 year if revenue stays flat over the same time period. Now, by contrast, Adobe's profits are not as severely impacted by high inflation or inflation of 5%. In its most recent fiscal year, Adobe actually posted gross profit margins of 88.2% and operating profit margins of 33.6%. And if we now use these figures, then as you can see, a 5% increase in raw material prices has almost no impact on Adobe's operating profit. Operating profit declines by only around 2% if input costs increase by 5%. Let me just reiterate what we've just shown. If input cost inflation is 5%, our home builders' operating profit declines by more than 30%, whereas Adobe's operating profit only drops by 2%. Isn't that amazing? I'm not sure if you have watched the video in which I discussed the quality of the businesses in my portfolio. In that video, I calculated a so-called look-through table, and I showed that the look-through gross margin of my portfolio is 58%, well above the S&P average of 45%. So this analysis basically gives me confidence that the companies in my portfolio will likely do better than the average S&P 500 company in a high inflationary environment. So that was my first tip. Let's move on to my second tip. Earlier we've said that inflation occurs on different levels, on both the company level but also at the consumer level. And while at times input cost inflation may significantly differ from consumer price inflation, usually CPI and PPI come in pretty close to one another, at least over time, even though the PPI index is, as I just said, generally more volatile. So let's expand our model a little bit. We've previously said that input cost inflation is primarily increasing cost of goods sold on the income statement. On the other hand, consumer price inflation will mainly impact a firm's revenue as well as indirect operating expenses. So as you can see, if we add consumer price inflation of 5%, the profitability of our home building business basically remains unaffected. But the question is, can the business actually raise its prices without losing customers? Because not all companies enjoy, what we call pricing power. A company with pricing power can increase its prices without losing customers and seeing a decline in demand. Companies without pricing power, however, or on the other hand, they are forced to cut costs, boost productivity, or simply absorb the costs through lower profit margins. This is what we have shown previously in this video. So of course, businesses that can raise prices without losing customers are the businesses you want to be invested in. Some companies can even raise prices above the rate of inflation, and of course can create a lot of shareholder value by doing so. See's Candies and Apple are probably the two most commonly cited examples here. And Warren Buffett, he agrees with this philosophy. He once said, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising the price by 10%, then you've got a terrible business." And we can actually illustrate the superiority of businesses with pricing power with our model. If a company can increase its prices and thereby its revenue faster than the firm's costs of goods sold go up, the firm's profitability will go up as well. In the example that you can see on screen right now, for example, we assumed consumer price inflation of 8% and input cost inflation of 5%, again for our home building business. If on the other hand a company does not have the ability to pass on increases in input costs to consumers, then the profitability will go down. We can also just plug in the current CPI and PPI numbers. The year-over-year change of the PPI index was 19.2% in January, and the consumer prices are up or were up 7.5% year over year. If those inflation rates would persist for a longer period of time, the outcome for our home building business would be absolutely devastating. If you want to learn more about the impact of inflation and how you can best protect your portfolio, I recommend watching the following video in which you will learn basically why Warren Buffett thinks that distinguishing between commodity products and highly distinguishable products is absolutely critical if you want to find winning stocks.